Investing for retirement success, or retirement investing success. That's what I'm going to talk about today. Mostly, fundamentally, primarily, I believe I do that each and every week. Now, I'm actually calling the show Know-How and also preparation. Know-how and preparation. I was inspired by that because, candidly, right now, as I am recording this radio show that is going to air on WJBO, and as you're listening in, for anybody on the radio, it is Sunday in early mid-September here. But we have just had, for those listening in, a week of a storm. So I'm actually recording this before the storm is about ready to hammer us. And in that consideration, I've decided to call this show from an analogous perspective with respect to an actual real weather storm and what we need to do, which is know-how and preparation, because it's important when you're getting ready for a hurricane and a storm, no matter what that is to know what you need to do. What's the know-how and what's the preparation you need to be doing to protect yourself, because the storm is forthcoming. As I am recording this right now, there's a little rain outside and we have not been quote unquote hammered yet. Let me quickly say, you're listening to the Retirement Income Source. That's the name of this radio show. I'm your host, Drew Pelton. And this is, in addition, the second podcast. So we are integrating the radio show into a podcast. Perhaps you're watching me on YouTube, those of you that are on YouTube, and you're watching and listening. So I just want to let you know, those of you that are listening by radio, that this radio show is integrated so that you can catch the podcast in addition. And that may help you if you want to go back and listen. Now, I also want to offer, for those of you that like to go online, you can go to our website, www.drewpelton.com. And when you get on our website, you can click on the media tab. And when you click on the media tab, you'll see radio. And then as you go forward, you'll be able to see that there are the past shows for just listening. Perhaps we'll have the podcast version on the website, but maybe not, because you should be able to go back and watch previous podcasts as they start to add up here as we go forward. So all of this is to help with the opportunity for people to listen in better, more people to listen in, because what are we doing and what am I doing and what is this all about as far as I'm concerned? It's all about you. And it's all about you, and it's all about you and you investing for success in retirement. And how do you do that? Well, I'll tell you, it actually is all about income. Income. It's all about investing for income, so you can have what? So you can have preservation, so you can have growth and income. What drives the success of a retiree's investment portfolio is mostly, and I'm saying it that way to pause here a little bit because I just said it is all about income, but for the most part, it is mostly about an income generating approach to investing so that you do have preservation, growth, and income. I mean, I repeat this over and over again because most people out in the world of investing or dealing with advisors and advisory firms that are either on one end of the spectrum or the other. One end is primarily this growth strategy, this take risk strategy, this buy and hold only strategy, these strategies that say, stay put, you'll be okay. It's all an accumulation phase strategy. And then they're really not retirement specialists, these firms or the advisors you may be working with, because they're telling you to stay put, take risk, don't worry about things. Well, I want to say this, and I hate to say this in the sense of stepping on somebody's toes, and I don't mean to just step on people's toes. That's not my purpose. My purpose is to help retiree investors. But I want to say, if anybody you're working with is telling you to, and you're retired, and they're telling you, stay put, you'll be okay, don't worry, markets go up, they go down, hang in there, everything's going to be okay. And if that's all they have to say, which is basically an accumulation phase strategy type of approach or words, if that's all they have to say, okay, here it comes. Either run or at least walk away. That is not a retirement specialist. That is not a retirement income specialist. Why? Should be very, very obvious. When you're in the accumulation phase and you're saving money and you're adding money and you're doing dollar cost averaging and everything is good and great because you've got time and you have earned income that you're living on and you're not taking any money out of your investments, well, you can feel good and secure, and you know that there's going to be an accumulation and it's okay. And you're probably just using mutual funds because that's mostly what most retirement plans have to offer, whether it's a 401k, 403b, 457b, whatever it is, or whether it's pre-tax savings or after-tax. Many retirement plans have a Roth component. But the problem is when you are very close to retirement or in retirement, whether it's day one, week one, year one, or whether it's 5, 10 years in, or whether you've been retired for 15, 20 years, if somebody's got you programmed for, and you've got yourself programmed for the stay put, you'll be okay, and you've gotten a little myopic here where you're thinking, well, look, the markets have been up 13, 15 years, depending on how you want to think about it. Since 2009, basically, markets have been starting to go back up, meaning they started to go back up in 2009, although there was a little period of time there between 2011, 2009 and 2011 when things were still not certain. But ultimately, since 2009 through this time here in September 2014, we've had, I would call that, 15 years of an up market. And as most Americans do, we get myopic. We forget that there could be risk. It's just like, how many people really think about 9/11 on a regular daily basis? Probably not too many. I mean, we get reminded. We did. This is the day of this recording is September 11th, and I hope everybody is remembering what happened to us back then and the importance of protecting this country. But we have a tendency, I believe, to move on, and part of that is our strong American resilience generally, and the power that we have as a country and a people, et cetera. Well, it's good to move on, but there's certain things we want to keep in the forefront of our minds, I believe, such as 9/11 and the importance of making sure that we really are free. Freedom is not free. Well, the same thing in retirement. It takes, I'll say, retirement success is not free. It's not free of, you can just set it, leave it, hope and pray, because a lot of you think that you're doing buy and hold, and that's what you're supposed to do, which is an accumulation phase type of a thinking and strategy. But really what most of you are doing once you retire is you're not doing buy and hold. You may be doing buy and hold in terms of what the actual investment approach is, but you really mentally and emotionally are doing hope and pray. And you're hoping and praying the markets don't fall out. Well, here's what the situation is. Just think about back in the late 90s, meaning before the tech bubble burst, and just basically since 1982 through the year 2000, what happened is that there was an up market. It was 18 years of the longest secular bull market in American history. And in the year 2000, the tech bubble burst. And over a 2-3 year period of time, to the year 2000 through 2002, most people lost 50% of their money if they weren't adding money to it. I mean, because that's something to pay attention to. So the question is where are we now? Those of you that believe that Trump is going to be elected, that's just not an opinion on my part, by the way, but, let's say that you're a Trump fan. Let's say, and I'm happy to tell you right here on camera that I'm a Trump fan. I'm a Trump fan easily, even though I might think he could be more presidential in a lot of respects. But I'm a Trump fan because I think he's a businessman that knows how to get this country done right. And he's not a politician and a government guy that wants to spend government money that comes from the taxpayers and my hard-earned dollars and your hard-earned dollars. So if I stepped on anybody's political toes, I'm sorry. I'm just, I have my opinion. You have yours. It doesn't really matter. Because what matters here on this show is what are you doing? And what you want to understand is it truly is all about income. It's about income investing. And I hope and pray you're not turning this off because, perhaps you socially speaking, you're a Democrat or you believe in the progressive ideas of if you do, you do. God bless you. And, we work with people that have no political affiliation or they're Republicans, Democrats, or whatever you might be. It doesn't matter. What matters is how can we help you? The bottom line is you need to do what works. I'll just go back to Trump for a second. I personally believe that he has an excellent track record. He was the president of the United States. He did have a strong economy. We did have low interest rates. We did have low inflation. We did not have any wars. So, okay, there's my positioning. I used to, by the way, I'm digressing here. I used to do a lot more a couple of years ago, and this was probably pre-Trump and, early on Trump, and I'd say a lot more and I'd say a lot less. But I got to tell you, I think it is right, and I have the right. This is my show, and I'm digressing here on a political front. But I think those of you, if I may say, with all due respect to you, those of you that only watch CNN, only watch ABC, only watch MSNBC, I like MSNBC from the perspective of certain new financial shows, but I want you to be careful because, there is a statistic that I saw that ABC has given Kamala Harris 100% positive voting, or I should say positive coverage. Everything about Kamala Harris is 100% upbeat, positive. She does no wrong. She walks on water along with Jesus, so to speak. Excuse me, I don't mean to be sacrilegious, but obviously she doesn't. But they give her 100% coverage, and the statistics say that Donald Trump gets 7%. Now, I would call that about as unfair as it comes. So now, maybe on the other side, we could argue that Fox News and Newsmax does similar, but I think they're a lot more balanced, in my opinion. The bottom line is you need the right information. Well, I'm going to breathe now. So I have a lot to say. Again, you're listening to the Retirement Income Source. Thanks for joining me. Happy to be doing my second podcast because we just, I've been doing the radio show for many years, but we have integrated the radio show into a podcast. So this is the second podcast show. So I'm looking you in the eye. I'm a little more casual today than sometimes I might be, where I might have a suit and tie. I usually don't wear a tie, candidly, but I might have a jacket and a dress shirt kind of thing. But I'm recording this show on Wednesday, September 11th, 9/11, here, 2024. Well, we are waiting for the storm, and most of you are at home, when I'm recording this, and most of you now hearing this are hearing this after the storm. But the whole thing is, what's happening is people are preparing for the storm. But before you prepare, you have to have know-how. And the investment analogy here is you need to be prepared, but you need first to have some know-how. What's the know-how in investing in retirement so that your money lasts, so you're not doing the accumulation phase strategy of investing, taking on too much risk, as I've been talking about here on the show, but where you can have preservation, you want growth, you can have growth, and you can do that through high yielding assets that give you income, meaning income from your investment. So what is the income? The income of the yields. So I'm going to come back and talk about that in just a moment, but I wanted to, I'm going to take a quick break, and I'm going to come back and I'm going to tell you about what just happened in this past week earlier. That actually, this is a good client, but she's only been on board with us for a couple of years. And I want to tell you about her question and what she asked me with respect to income and yields that may be what you're thinking, and why I always keep saying and why we keep talking about income, income, income. The name of this radio show and podcast is the Retirement Income Source. That's the name of the show. And I'm your host, Drew Pelton, and I'm talking about income, 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 income. It's all about income investing to get the job done if the source of your income is right. The retirement income source. So there's power in those three words. And if it's followed correctly, you will have successful retirement investing. That's what we're all about. That's what we're talking about. That's what I'm sure you want. You want to win the game. You want to win the day. You want to win the Super Bowl. You want to win the World Series. You've got to do that so you can have peace of mind, so you have the prosperity that you need and want. So I'm giving away today my partner's book called The Retirement Income Story. He's already updated it. I just don't have copies of it right now. And if, at some point, we're happy to, those of you that call in for this book, we're happy to get this updated book to you when it comes out. You just have to tell us and, get on that list. But for right now, this is a great book, The Retirement Income Story. It'll help you understand the power of investing for income, the advantages of investing for income, the need to invest for income, where you can have the right balance for you all customized. All right, I'm going to take a quick break. And as I said, I'm going to come back and I'm going to define further this difference between accumulation phase investing and distribution phase investing. Distribution phase investing is when you're in retirement. It's the retiree success way to invest. And I need you to understand the fundamentals so you can best think about that. All right. Thanks for being with me. I'll be right back. You don't want to miss 1 minute. I'll be right back. Thank you. Welcome back, or thanks for joining me. You're listening to The Retirement Income Source, the name of this radio show and this podcast. I am your host, Drew Pelton. It's all about income, and it's always about income. And candidly, frankly, historically, by way of the results, it has always been about income. Let me just start out with this very directly, and I'm not reading from my little charts, but I know this, that generally in a 40-year study, I can remember a study that concluded in 2019, so going back 40 years, that basically the way it works is that the investor that invested in stocks that paid dividends did just under an annual return of 13%. I believe it was 12.8%, so I'm just going to say just under 13%. The investor who invested in non-dividend paying stocks got just under 9%. So effectively, it was about a 4% delta, a 4% difference in results. Now, I know that everybody out there in podcast land and radio land, everybody loves math. I know that. I know you love math. Everybody's in the Drew Pelton Math Club. I'm sure of it. I know probably right now there is a lot of laughter wherever you are, at your home or in your car when I say that, because obviously I would think maybe you know, and if you don't like math, let me just tell you, you're in the majority. I know by my own surveys, I know by conversations I have with people, most people don't like math. And when you don't like something, what do? You tend to push it away or get away from it. Well, the reality is that even a 1% delta or difference is huge over time in terms of the results. When you start saying, hey, every year I get an extra 1% as an example, or an extra 2%. But I just gave an example of dividend in a study, in a 40-year study, that dividend paying stocks got 4%, virtually, 4%. It's not like well on it. It's like, just think of it for simple. 4% better annual average return. It is huge. You know what the difference is? Well, and forgive me because I don't have this chart right in front of me, but I am rather certain I am correct about this, that the investor who started out, let's say in this 40-year study with $100,000, if you had $100,000 40 years ago, then, and I'm going to do a 10,000 example because it's pretty straightforward and simple. But the $100,000 investor that didn't touch the investments, and that sounds like I'm not following through with my distribution phase, and it's just to make a point because the distribution phase strategy is important and investing for income. But right now, I'm just talking about the return. Well, it's $5.7 million that the $100,000 turns into with this annualized return of earning 13% per year, as opposed to the 8% area with the 4% difference is $1.7 million. Would you rather have $1.7 million or would you rather have $5.7 million? $1.7 million or $5.7 million? Which one suits you? Well, first of all, many people going back 40 years didn't have $100,000 to start with, and sometimes people have to take money out. Certainly, if it was IRA money or some kind of retirement plan, you have to take RMDs, required minimum distributions out. But what's the key? The key is it's all about income, 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 income. You want to make sure that you are investing for income. What does that mean? So that's what I said I was going to be talking about. Now, before I do that, and I think I did not give you the telephone number, but I'm going to pause right here. Sometimes those of you listening in on a regular basis, I get on a roll. I don't do as many offerings as maybe I could, but let me re-offer this book. For those of you that would like to get a copy of the book, The Retirement Income Story by Dave Scranton, he's my partner. He is the leadership primarily, and we have an entire team of leadership that leads up our 100 offices around the country. But for right now, let me say this. Dave, a brilliant guy with all the letters after his name, has written a super book, and there's an updated copy that just hasn't been released yet for us to get copies of. But the bottom line is you can get a copy of The Retirement Income Story to help you understand how to invest for income, why it's so important to invest for income, and how you can proceed. Today, I'm talking about the importance of know-how and preparation. I'm motivated again by the storms we have forthcoming here in Louisiana, Wednesday, Thursday of this week, September 11th and September 12th. But this book I'm giving away, it works every day of the year, all the time, to be prepared for you, so you can have the know-how, so you can have the preparation, so you can understand the power of investing for income, so you can invest for income, so you can have preservation, so you can have the growth you want and the income you need. Because what do you need in retirement? You need income. You're in a distribution phase. You need to understand that. So bottom line is, what you need is to get this book is you need to call us on 225-831-1394. That's 225-831-1394. That's our office line right here in Baton Rouge, Louisiana. And if you're listening in on iHeartRadio, because the WJBO radio show also airs on iHeartRadio, and maybe you're listening out of the state of Louisiana, and you're welcome to give us a call, and we're happy to get you a copy of the book. And that leads me to, if you'd like to talk to me off air by way of telephone call, Zoom meeting, or an actual meeting in the office, then you can set up a time when you call and ask for the book. Or if you're coming in for a meeting, we're happy to give you a copy of the book when you come in. Whatever works for you, because some of you need a complimentary analysis of your portfolio. People come in to our office, and they should, and they need to, I would say, bare their soul by way of, what are you doing? Bring your statements and we'll show you. Most people are not investing for income. Most people are investing for growth. Most people have too much risk in their portfolios. Most people have low yield. So let's go there, as I said I was going to do, which is, I'm going to do it by way of a story. So we have a good client, and without all the details right now, and there was some estate planning we did for the client that led to us helping them with their investments. Actually, just quickly, her husband passed away. And so she's been a client for just about a year. We were working with her. We've been working with her for a year because I did a fair amount of pro bono work with her and coordinated with the attorneys. And ultimately, she wanted us to handle her investments. And she was, by way of, and not to pick on her deceased husband, but he was a do-it-yourselfer, and he just had too much. He was scattered. He had too many accounts. I believe there was 22 accounts. He thought that was diversification, working with all these different companies. He was over allocated, over diversified, and it wasn't effective. And the portfolio wasn't performing well. And he absolutely was not investing for income. Well, I'll just say Mrs. R, we'll just leave it as that, as who this client is. And she came in, and so we were having a good meeting, reviewing. She's doing very well. I can't promise this. I'm not promising this, but bottom line is, with under a year of full investment, she's up 11% with a lot of solidarity in her investments and not taking over risk. She's doing it the right way, if I may say. So we have a little formula, which is called TR equals I plus G, total return equals income plus growth. So Mrs. R says, throughout the discussions about how well she's doing, she likes what we're doing. It was done in a strategic way, basically, where we start out, there's a process. The process started with estate planning. We do a full investment plan. There's tax planning involved. It's planning. There's process, there's planning. The planning leads to a strategy, and the strategy leads to the execution that we are in the process of and what we're doing. So the execution of the plan and the strategy is unfolding, and she's very happy. But still, even though she understands this message of income, she says to me, now, what's a yield? Because I was talking about her statements and I was talking about a yield. And so let me quickly say what words are interchangeable, and I'll break it down for you. Income is a yield is an income. So on your statements, when you're meaning your financial statements, generally speaking, most companies have a column that says yields, and a lot of times it's to the far right. And the yield sometimes will say right next to it or right under it, income. Or the far column may say yield and it gives a percentage. The column right before it may say income. Well, income relates to the actual dollar amount. Now, I know what I'm saying for some of you listening in or watching is fundamental. But for so many, it's like our new client who's heard the message of income, and I'm not picking on her because I just know how it goes, because most people for 40, 50 years sometimes are used to hearing about the G. What's the G? It's growth, it's gains, it's everything's about gains. And that's the message. It's the accumulation phase of investing. It's capital appreciation without the thought of capital losses. And maybe that's okay again on the accumulation phase. So we've discerned that people need to understand, and they particularly need to understand when they have the opportunity to invest for high income, the formula of TR equals I plus G, total return equals income plus growth. So when you look at that, that can help you assess what you're doing now versus what you can do. In other words, how do you meet up and match up to result-wise on the income side and the growth side that may be /L as G as an L. So the client says to me, Mrs. R says, so what's a yield? So what does that mean? Understandable. In no way, shape, or form am I picking on our, relatively speaking, new client after a year. But this is so normal because what has she heard most of her life? She's heard what 99.9%, I believe, of people investing have heard. And that is R equals G. Okay, that's not TR equals I plus G. It's R equals G. Return equals growth, or G equals R. Growth equals my return. Well, guess what? If G is not the G and G is an L, it might be L equals return. Well, over time, normally, you do have G equals R. But truly, soundly, when you're investing for income, you would, an income where you get high yields in the 5 to 7% category on the I side, because this is the G side. What you really want is 5 to 7% on both sides. I just gave an example in a 40-year study that ended in 2019 that went back 40 years, that the stock investor who invested in stocks with dividends got just under 13%. I believe it was 12.8%. In annual return over time. That can happen. Now, let me quickly say, when you're in retirement, you may not have 40 years. If you're 60 years old and you retired, you probably, are you going to live to be 100? You could. Back to the message of income here and the message of what I'm saying with Mrs. R. So Mrs. R is saying to me, now, what's a yield? So back to the statements, it says on your statements, most financial statements say yield, and it's expressed in a percentage. Very often you are going to see 1%, 2%, 3% at best in most statements. Now, if you're a do-it-yourselfer, maybe you're averaging 3.5%. Okay, I can tell you our yield column is showing on average 5 to 7% because we invest with that objective in mind. If the asset's not going to be falling within a 5 to 7% income, 5 to 7% yield, 5 to 7% interest overall. If it's not going to meet that criteria, and I'll say this, the common stock generally are about 4.5%, which is very high, but the preferred stocks are, generally speaking, 5% or higher. So I'm giving you the categories that allow for these kinds of interest returns, because you need generally a good balance between stocks, common stock, preferred stock, bonds, bond, ETFs, exchange traded funds, BDCs, business development corporations, REITs, real estate investment trusts. And it's not just the categories, there has to be hand-picked, hand-selected for purposes of high income, high yields, high dividends, high interest. What's a dividend? A dividend is the earnings that is shared with the investor from the stock, and that's a separate part of the equation of total return. It's the I part. So let me just sum it up and say it clearly. Income is yield, or income is either a dividend from a stock or interest from a bond or a bond-like instrument, like a BDC or REITs. So that's the earnings part. But the growth part, which is the appreciation part, the capital appreciation, that again, you have to keep in mind could have capital losses, but you want to look at both sides. The key thing is when you are investing for income and you don't have to invade principal and you can live off the income, where it's income from income. You want to invest for income so you can get income from the yield, income from the interest, income from the dividend. I know I'm being repetitive, but so many of you are so programmed with the G. I'm going to take a quick break and I'm going to leave you with this before I come back. And you don't want to miss this, because I'm talking about know-how and preparation, and I'm giving you that. And I'm again using that as an analogy with the storms as you're listening in from this past week. And the bottom line is that it's all about income. Here's the little saying you might want to think about. If you want to have a retirement that is stress-free, invest more for the I and less for the G. I'm going to say it another way. If you want to have a retirement that is stress-free, focus your investing more towards the I and less for the G. You're going to get the G by investing in the I if the I is strong enough. I'm talking about the I, the letter I. I is an income. So I want to be clear here. Some of you are like, Drew, why are you talking about body parts like the eyes and ears? No, I'm not talking about that. I'm talking about I income. I income, which is expressed in yields on your statements, which are either dividends or interest, as I'm saying. If you want to have a retirement that's stress-free, invest more for the I and less for the G. All right, I'm going to be right back, and we're going to talk more about the components that you want to think about to get to this successful retirement investing where you are investing for income. All right, stay tuned. I'll be right back. You don't want to miss it. Welcome back. You are listening to or watching the podcast, The Retirement Income Source. Let's slow that down. The retirement, you're in retirement. Income, what do you need in retirement? You need income, whether it's because you need to supplement your lifestyle or supplement other Social Security or pension income, but you need it for your lifestyle. And then the key is, what's the source? Where is the income coming from? Is it coming from low yields that are going to force you to take monies out of the growth, which could be considered possibly acceptable sometime or some years during your retirement? Or are you actually going to have to invade principal because in a down market, the yields are not good enough for the income you need? And then you end up invading principal by way of having to sell shares. Why would you have to sell shares? Well, if you're taking income, let's say you have $1 million and you say, I'm going to take 5% out. If you're getting yields of 5% and you take it out of the yields and everything's good. So in an up market, you're fine. Let's just say you have the yields, growth is fine. And let's say even if you had low yields and you're getting at least 5% in growth, well, you could argue you're okay. Where retirees get into a problem and where they don't really know what has happened or has happened to other people, where people start running out of money. It is the biggest fear that retirees have by way of the studies. It's the fear of running out of money. How does it happen? It happens because in down markets, when people have low yields and the stock price goes down, and the only way to get the income, this, let's say 5%, let's say the yield is only, I'll give it even 2%. And most mutual funds have less than a 2% yield coming from them in stock funds, most of them. And so if you take out 2% from the yields as an example, and the stock price is down, the market's down, and you need to get other income, you need to get this other 3%. Okay, and then this is part of the problem, because now all of a sudden you don't have the $1 million because the markets are going down. But the bottom line is, when you need the same income, let's just say you needed $50,000, because the 5% of the million in my example is equivalent to $50,000 a year. But if you need $50,000 a year from your investments in my example, and whatever your number is, lower or higher, then just translate and just make it happen in your own mind and the thinking. But I think it's pretty easy to follow this. So what does somebody have to do? What is the fundamental thing they're going to have to do in a down market with low yields? Well, if the stock price is down, the only way to get the same amount of income is you have to sell more shares at a lower stock price to get the same amount of money. I mean, this is so basic and fundamental, but who's sharing this? Who has any? I'm asking you. I mean, I'd love for somebody to write in and say, oh yeah, I'm working with a guy, a gal I have for a lot of years. I just started working with them. They explain this to me. Do you know that I've been doing this for 45 years. I have not one person ever. I've talked to thousands and thousands of people. I've seen thousands and thousands of financial statements. Do you know I don't have one person that has ever said to me that they had someone explain to them exactly what I'm saying? And you know why? And it's pretty simple. Well, first of all, before I tell you do you know why, I'm going to say, if you understand what I just said, this about having to sell more shares, because I want to finish this thought. This is how people run out of money. They're taking on too much risk. Somebody's telling them to stay put, you'll be okay, hang in there, markets will come back. Well, when you're taking money out, you're in the distribution phase and you haven't shifted to an income-based focus of investing, and you sell more shares and the market keeps going down and you keep selling more shares, let me ask you what you have at the end of the declining market. When at the bottom of the market, what do you have? Now, I know this is a very deep and complex kind of a question, but I think you can get it. It's less shares. You have less shares. Now, let me ask you, if you're not working and adding money, are you ever getting those shares back? You see my head already? No, you're not getting the shares back. They're done. They're gone. You sold them. This is how people run out of money. Let me say it this way. This could be how you run out of money unless you make a strategic, intelligent, smart shift from the accumulation phase strategy of investing, which is primarily based in growth types of approaches, to a distribution phase strategy of investing, which is the strategy of investing for income, where you get income, earnings, high income, high yields, high dividends, high interest. It's all the same. It's the I. TR equals I plus G. Total return equals income plus growth. So I know I'm going to pause slightly, so to speak, for a second, but I can just hear somebody who listens in on a regular basis going, Drew, you're saying the same thing over and over again. I'm pausing intentionally. Well, this is what I want to say. What in the world is everybody listening to over and over again in some form or fashion on the news from the advisor? They're listening to G, growth, 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 capital appreciation, capital appreciation. That was the message of, well, I'll say it's the message of virtually any time most financial advisors. It's all about the G. That's all they're going to talk about, the G. They're not talking about the potential losses. They're not explaining all this. It's like at the end of the 90s, particularly, let's just say the last 5 years, the last 3 years, the last couple of years, everybody thought the world is different. It's the dawning of the internet. Everybody's getting rich. There's AOL, there's Intel, there's Microsoft, et cetera, on and on and on, all those companies that ended up, by the way, all taking a hit. It was almost as if, well, now that we're at the dawning of the internet, markets will only go up. They can only go up. There is nothing called declines. There's nothing called risk. The world is so different now. There's a little bit of that message, that fervor, that unrealistic thinking and approach with respect to AI. What's AI? For those of you that don't know, it's artificial intelligence. Well, yes, we have these times in our history, in our investment history, in our developments in life, whether it's the dawning of the automobile or airplanes or the internet or technology generally and computers, et cetera, or now AI obviously is the big thing to think about, and it should, if it's handled right regulatorily, should help us out. But all of this said is what is the realistic way to invest? Because if it's just all about the G and you're not factoring in the L, meaning if it's all about the growth and capital appreciation and you're not planning for the L, just like happened in 2000, or I'll say the couple years before the year 2000, where the bubble burst and most people lost 50% of their money. I know people that lost 70% of their money. And the markets came back in 2007 after it hit the bottom in 2002. But then we had the housing crisis. Well, and now where are we? We are 15 years or so, 13 to 15 years, depending on how you think about it, in an up market. Well, where were we with the high-tech bubble creation? We were there from 1982, 18 years up until 2000. Well, things change. I had somebody say to me recently, they said, coupled to the thought of there's only two things you can count on in life, or only two guarantees in life, and that is death and taxes. And they said it's actually three things. I said, okay, I'm listening. It's death, taxes, and things are going to change. Things change. And you as an investor have to be prepared. The title of this show today, you're listening to the Retirement Income Source. I'm your host, Drew Pelton, but the title of the show today is Know-How and Preparation. You better know how to be prepared for the storm, the weather storm. You better know how to be prepared for the hurricane. You better know how to be prepared for the tropical storm that brings with it a lot of rain and more probably damaging the winds that could blow things around. So is your house secure? Was it secure this past week as people are listening in here? Because I'm, again, doing this on Wednesday, meaning I'm recording the show on Wednesday before the storm is really hitting. It's starting to rain outside as I'm doing this, about 11:45 noon on Wednesday, and it's still easy for myself to get home. I'm letting my staff go home early today, but already the town is closed up. Already LSU and governments, etc., are closed Wednesday and Thursday. That's announced. I know my church on Tuesday, yesterday, closed the service on Wednesday. And so, okay, I understand. And so we have preparation. We have know-how. We know that we have to secure things that might be outside and secure windows perhaps and doors, whatever that might be. We have to know how to do that. And you then are prepared. So it's hard to be prepared if you don't have the know-how. So what is the know-how in investing? Well, there's a couple of things. Number one, fundamentally, no matter what, it is all about income. It's income, income, income. It's income investing. It's investing for high yields. That's what the answer is. Income, income, income. But where do you get that? You can't just get it from the cookie cutter salesman. You can't just get it from the mutual fund salesman. You can't just get it from the annuity salesman. You have to get the income from your investments so that you can live off the income from the right investments. What are the right investments? Typically, you use only individual securities when you're investing in the world that does have some risk. I mean, the obvious is stocks and bonds and other financial instruments, other securities. And that's another question people have. What's the security? Well, an individual security is an individual position, or it's a stock, it's a bond. They're considered securities. And so these individual stocks that you can own that pay high yields, which is, again, dividends come from stocks and interest come from bond and bond-like instruments, meaning bond and bond-like investments. So when you have high income, high yields, and you can live off of that, then you can be on a better plan to preserve your money where hopefully you don't have to invade principal. I find one of the most ludicrous things that I hear in the planning world is, and I even have some clients that have some of their money. I can think of somebody has some of their money with Ken Fisher, and and the gentleman, really nice guy, he's a good client, I like him. But there's a little, with all due respect to him, there's a little hard-headedness there. Well, I have to have more than two advisors. Okay, well, to each their own. We still work with you. That's fine. Okay, but he comes in and he says, well, according to Ken Fisher, following, and I'm not saying it's all Ken Fisher because I don't know their whole model, but this definitely came from Ken Fisher, who, by the way, I have another story about how they only generate 1.8% in yields. And I'm not saying that, but I got that, directly heard that from a Ken Fisher representative. So that's another part. Well, that's not a good thing. But let me go to this thing about Monte Carlo. We did the Monte Carlo analysis. Okay, fine. We like models. We like looking at mathematical systems and models. But this particular one is, guess what this one is? Well, according to the Monte Carlo analysis, you won't run out of money until you're 87, 92. Now, I would like to start with, as they say, begin with the end in mind. Here's my end. I haven't run out of money, and I'm not going to run out of money. So effectively, the Monte Carlo system analysis plans for you running out of money. Oh, well, let's see how, because it's taking on risk, I believe too much risk, and it's considering the money you're taking out. Well, you know what? It almost effectively, its admission, its message and its mission is not about income investing. It's not income. It's growth, hope and pray, take on risk. You should be okay according to history. Well, history is good. Analysis is good. but it's got to be about income. That's the message. It's income, income, income. Okay, I'm giving away, hopefully everybody's hearing that. It's all about income. And I'm giving this message daily, giving it weekly. And by the way, I don't think I really cleaned it up. But the reason why it's all about income all the time on this show is because the world generally is all about the G, growth, growth, growth. And so part of what I'm doing here is pushing back against this growth accumulation phase strategy of investing for retirees when they are in a different phase of life. So this book, The Retirement Income Story by David Scranton, is a great book to help you understand the importance and the power of investing for income. I would recommend you get a copy of it. You can call us on 225-831-1394. That's 225-831-1394. That's our office line right here in Baton Rouge, Louisiana. Call us during normal business hours. Now, let me give you another number in case you're driving and or you want to call in during the weekend, or you don't want to talk to anybody in the office right now. Call us on 1-833-974-1833. That's a 24/7 number. We have an associate that is in a call center, so it's not my office per se, but they'll get the information to us. And also, if you'd like to talk to me off air, please give us a call on I would say, the office line during business hours. If you'd like to talk to me on the telephone, if you'd like to talk to me by Zoom meeting, if you'd like to come into the office, if you're here local, whatever works for you, call us on our office line, 225-831-1394. All right, I've got a few minutes left. I'm going to take a quick break. Hang in there. I know you don't want to miss the wrap up. Again, be prepared, but have the know-how so you're prepared the right way. I want to thank you for being with me as you're joining me, and hopefully you are getting a lot out of this, because I'm giving you the power of successful retirement investing, which is what? Income investing. It's the income generation that comes from income investing, which is all about high yields. All right, stay tuned. Don't miss the wrap-up. Thanks for joining me for this short 1 minute or so wrap up. You're listening to The Retirement Income Source. I'm your host, Drew Pelton. Please be with me by radio every Sunday on WJBO from 11 a.m. until noon Central Time. I'll be with you here to help you invest successfully in retirement, understanding that the basic fundamental approach is investing for income. And for those of you listening in by way of podcast, please find me anytime you can, or you can find us on our website and watch the previous shows. Today, I've been talking about the know-how and preparation in investing. Just like you have to be prepared for the storms of life, the storms with weather, as we've had here this past week, it's important in your investing. Things you need to think about is proper allocation, low fees, low expenses, and the approach and the strategy that works in retirement, which is an approach of investing for high yields, which is high income again, and high dividends and interest. That's the power. It's all about income. Income, income, income. Don't miss next week's show. Have a great weekend. Be blessed. And by the way, last thing is we have a couple of seminars that are coming up over the next week and the next couple months. If you'd like to find out about those, it might be important for you to fill in some of the blanks here that maybe aren't covered in the podcast or the radio show. Call us on 225-831-1394 to register. Just call the office. We'd be glad to get you scheduled in. All right. Again, thanks for being with me, and be blessed. I'll be back with you next week on the next podcast and radio show. Thank you.